Hello guys, welcome back to Crypto Point. In this video today, we tell you everything that's going on in the crypto market, give you sound advice about the ongoing bear market and how to go through it. But first, subscribe to our channel and hit the bell icon to never miss a video from us. That said, now let's get started. When the year 2021 comes to a close, it'll be recognized as a good year for equities with a bull market rather than a terrible market. Over the last 40 years, the S&P 500 has almost doubled its average annual total return of 11%. In the case of cryptocurrencies, however, things were not only decent but extraordinary. The total value of digital currencies has increased by 176% to $2.14 trillion since the beginning of the year. New possibilities for decentralized banking, non-fungible tokens or NFTs, and the immense potential for blockchain-based gaming in the metaverse strengthen investor confidence while simultaneously propelling cryptocurrencies to previously unimaginable heights. However, there are also concerns that this year will not be as kind to cryptos. There are several factors that could lead to a bear market in crypto this year. Bull market versus bear market. A bull market is one of which prices are rising and economic conditions are generally positive. A bear market develops when the economy is weakening and the majority of stocks are losing value. Because investor attitudes have a significant impact in financial markets, these phrases also refer to how investors perceive the market and the resulting economic developments. A prolonged increase in prices characterizes a bull market. A bull market in equities markets refers to a rise in the price of a company's stock. During these periods, investors frequently believe that the uptrend will continue in the long run. The country's economy is normally strong in this scenario and job levels are high. A bear market, on the other hand, is one that is in decline. Unless the market has lost 20% or more from recent highs, it's usually regarded as a true bear market. Share prices are constantly falling in a bear market. As a result, investors assume the downward trend will continue, perpetuating the downward spiral. During a bear market, the economy slows down as unemployment grows as businesses cut staff. Market cycles. Market cycles, typically referred to as stock market cycles, are a broad word that refers to trends or patterns which arise in various markets or economic environments. Some securities or asset classes surpass others during a cycle because their business strategies are matched with growth circumstances. Market cycles are defined as a time interval between two consecutive highs or lows of a common benchmark, such as the S&P 500, which highlights a fund's performance in both up and down markets. Trends within a given sector or industry evolve in reaction to innovative solutions, new goods, or the regulatory environment, forming new market cycles. Secular is a term used to describe these cycles or patterns. Revenue and net profits may show comparable growth patterns among numerous companies within a given industry throughout these periods, which are cyclical in nature. Market cycles are sometimes difficult to determine until after the fact, and they rarely have a distinct beginning or end point, which can lead to misunderstanding or debate when evaluating policies and initiatives. Most market veterans, on the other hand, think they exist, and many investors seek investing techniques aimed at profiting from them by trading securities ahead of cycle directional swings. But don't worry, later this week we'll help you on what to do in this bear market and help you prepare an exit strategy from this bear market. Also, as you see, all of this knowledge is required first to prepare the exit strategy. You should know the market cycles and how it affects the market and know the basics of bull and bear markets. Fed's policy. Federal Reserve finally admitted that inflation was not merely temporary and hinted at the likelihood of multiple interest rate hikes this year. Now that the Fed has finally gotten over the transitory sticker for inflation, expediting the QE taper, multiple interest rate hikes are obviously on the books for this year. Mario Gattara, an analyst at market intelligence firm Analogica, told CoinRivet. There are no surprises there, which explains Wall Street's recent surge of optimism. The guessing game continues, though, with Jerome Powell praising central bank monetary policy as data-dependent. Monetary policy should remain the key problem for stock market performance, placing equities at the mercy of the Federal Reserve. It goes without saying that if there is a sustained period of increased inflation, things might turn ugly. He went on to say that while the crypto world appears to be a clear winner, despite its historic low correlation with the stock market, Bitcoin has shown a markedly different behavior in recent months, which could lead to a bear market. Along with a handful of meme stocks, the crypto bellwether pushed the rest of the coins into a risk-on, risk-off mode, in concert with stocks suffering a violent sell-off and languishing far off the all-time high, he said. It could be an indication of retail investors' reduced risk appetite, while a long period of stagnation could depress new demand and even further diminish the momentum badly needed to maintain crypto assets appealing to newcomers. However, Gattara concluded that if the rising inflation persists for a long time, things could get quite rough. The crypto market's history. It's possible that the crypto market will reflect the bear market condition with reversions following upswings being nothing new. The entire value of all digital currencies has increased more than 14-fold to $2.14 trillion from the bottom in March 2020. This is akin to the 35-fold gain in overall market value between March 2017 and January 2018, which occurred over a 10-month period. However, with the January 2018 high, the total value of all cryptocurrencies fell by about 90% over the next 11 months. Blockchain skepticism is a catch-22 situation. While the blockchain is fascinating, it's still in its infancy and has yet to gain widespread adoption. Businesses are still hesitant to jump at the possibility to support large-scale projects without first seeing proof of their success. However, none of this can be proven unless businesses embrace blockchain with open arms. It's a catch-22 situation that could lead the rally to be postponed and bear market restrictions to be imposed for some time. Margin debt. The amount of money borrowed with interest in investors to buy or short sell stocks is referred to as margin. Investors who use margins to leverage their trades can enhance their returns in some cases. However, if the stocks purchased on leverage do not perform as expected in the short term, brokerages may ask investors to put up more money as collateral or even compel the sale of assets, which is known as a margin call. FOMO. Some believe that fear of missing out or FOMO moves in 2022 will suffocate the cryptocurrency economy. The most well-known meme coins all have one thing in common: they don't have anything like a competitive advantage. For example, Shiba Inu may be one of the most popular digital currencies this year, but it doesn't indicate it'll have a long-term value. In short, there's no assurance that Shiba Inu or Dogecoin or Floki Inu, for that matter, will be the payment token choice for enterprises in the rapidly expanding blockchain sector. Furthermore, the Bitcoin market is really volatile right now. This weekend, Bitcoin suffered another significant knock, falling from $42,000 to roughly $40,600. Ethereum fell to just over $3,000 as well. The $40,000 and $3,000 levels are significant because they're psychologically significant for both assets. The two most valuable crypto assets have now returned to roughly $41,800 and $3,130 respectively, while other lower cap coins have not. Solana, Avalanche, and Polygon are all in the red today, having lost more than 20% of their market value in the previous week. Axie Infinity, a variety of DeFi tokens, and the meme currency Dogecoin and Shiba Inu have all been impacted by the market sell-off. While most assets have suffered as a result of the adverse attitude, outliers such as Chainlink, Harmony, and the Cosmos-based decentralized exchange Osmosis have increased in the last week. After the Federal Reserve disclosed its plans to raise interest rates, the stock market took a dive on Wednesday. This was a significant update since it showed that borrowing money would likely grow more expensive as the Fed works to control inflation. Risky assets such as equities tend to suffer in such circumstances. Cryptocurrencies, as this week's events demonstrated, tend to take a hit in such circumstances. While most major crypto assets have had a rough week, it comes after a protracted period of decline in the market. Bitcoin is currently down 39.2% from its early November high of $69,000, while Ethereum is 36.1% below its top. Many lower-cap currencies have lost 50% or more of their value. The popular Crypto Dread and Greed Index has posted a score of 23, indicating that the market is in severe fear following this weekend's wobbly price activity. And that's all for today's video. Don't forget to like this video and subscribe to our channel, CryptoPoint, for more such exciting content. See you in the next video.